Should you really keep your IUL? In this video, I'm going to give you 3 things that you need to do if you have an IUL that you're unhappy with. Now, before I start this video, I want to mention that I'm not anti-IUL. I use IUL in my practice, and in fact, I use it in a very, very specific way. So if you haven't figured out what I'm doing with IUL to make it align with my clients' needs in retirement, pause this video, take a minute, go watch this video right here. It breaks down my framework on when I use an IUL. But I am very specific when I use an IUL because an IUL is a very interesting type of life insurance. I think it's definitely the easiest type of life insurance to sell if you're an agent. Why? They come with these illustrations, and these illustrations can look pretty juiced up. And when you look at an illustration that's pretty juiced up, it's pretty hard to say no. Like, for example, if you look at an IUL illustration that's run to the max interest they can run, you can do all kinds of things with that kind of vehicle. I mean, you can show these massive income streams, you can show crazy benefits, you can have all kinds of, liquidity and potential index earnings. But again, what's important to remember is it's just a piece of paper. And just because it's on that piece of paper, there's a page on that piece of paper that says guaranteed, and there's a page on that paper that says non-guaranteed. And again, it says non-guaranteed for a reason, because they're just illustrating something. It doesn't mean that's what's going to happen. And oftentimes people are sold IUL as if that's what they should expect. That's why I don't use it that way. But if you have one of those and now you're sitting 2, 3, 4 years in and you're going, oof, this is just not really what I thought, there's a process you can put yourself through to look at it. So the first thing I want you to do is I want you to look at the surrender charges. Now, I'm not going to sit here and tell you should surrender life insurance. Number one, it has a death benefit, and that might be very harmful to your family if, God forbid, you passed away. Number two, I don't know what your situation is. So again, don't take any of this as advice. Take this as a framework that you can apply to see what could be beneficial for you. So when you're looking at your surrender charges, you really want to think back to your original objective. Why did you purchase the life insurance in the first place? What's funny about people that I meet with IUL who are often disappointed is they say something like this. Well, I was sold this, and yeah, it came with a death benefit, but I don't really want a death benefit, or I'm single, I don't have kids, I don't need a death benefit, I just wanted it for the income. I hear that all the time because they got this illustration that shows all these loans. First of all, if you get presented an illustration for an IUL and it's showing loans coming out at some point, that right there should be your criteria enough to say, this is not what I want, because it's just an illustration. You don't want to buy off that illustration, okay? That's really important because you'll be disappointed, most likely. It's very hard for that original sales illustration to hold up when you're showing that much loans coming out. And the other thing is, people don't realize what a risky situation that is. Like, you're going to put potentially a 70-year-old in charge of managing a complex loan structure with, changing loan options and indexing options and death benefits options that need to change. And then you're going to rely on the policy to perform to produce that. When you actually strip it down, it's a very thin margin of error that you're operating on for your retirement income that you need to be there. So when you think back to your original objective, look at your surrender charges and say, okay, well, is there another product that I could pivot to that would honor that objective, but make this surrender charge burden lessen? So for example, typically the surrender charges are going to be pretty brutal, especially in the early years, right? If you're in a 14-year surrender charge period and you're in year 4, you're going to get crushed for the money you put in versus what you'll be able to take out. And I'm not suggesting you take it out, but there's all kinds of advancements with hybrids, annuities, things that actually could be a more suitable next step to either provide income, or a lot of people purchased it because they did want the benefits for care. They like that had some type of living benefit rider, and they want that, to happen in their retirement. Hybrid long-term care products could be a suitable way to pivot. But again, I'm not telling you should do either of those two things. This is just how I think about it. Think about your original objective, look at your surrender charges, and figure out if there's a product you could pivot to that would actually be in alignment with what you want to have happen, right? When somebody comes to me and they want income, my first thought isn't life insurance. When someone comes to me and they need a benefit for care, my first thought isn't traditional life insurance. It's going to probably be some type of care product and some type of annuity product. That's what those do in their respective fields, right? So a lot of times we get into trouble when we are expecting one product to be like the Swiss Army knife. I'm sure you've heard that when you've heard agents refer to life insurance as Swiss Army knife. Well, guess what? If I'm out in the forest and I need to, dig a hole, I don't want my Swiss Army knife that's got a little mini shovel on it. I want a real shovel, something that's designed for that job. That's probably a bad example. You can tell I don't go camping very often, but that's my best example I can come up with. So take a look at those surrender charges, see if there's something that you could potentially realign with your original objective that's more appropriate. Okay, number 2 is performance. So oftentimes people have an illustration and it'll show 5% every year, 6% every year. The reason why I told you in the beginning where if you see an illustration that has loans coming out of it, that's dangerous, is because everybody knows that that index is not going to earn 6% every single year like a CD at the bank, or 5% like with a consistent rate of return, right? There's going to be variance in it. Some years you're going to hit your cap, some years you're going to get zeros. Now, if you've started out your IUL and you're in these proprietary indexes and they have not performed even though the S&P 500 is doing well, you may have had a year or two of zeros in a row. Well, I can tell you from looking at enough IUL illustrations that if you have 2 years of zeros right out of the gate, that original sales illustration you're saving with your policy is now worthless. That is not going to happen. It's going to be radically different. And people don't understand how much is happening inside this policy, how much cost that can be inside this policy between different charges, cost of insurance, premium loads. There's things that are putting a tremendous amount of pressure on this policy early. So if you're having poor performance or zeros early, that's going to be an indication that you're in for a bumpy ride, because a couple zeros can really throw off. Even 1% variance, if let's say you ran it at 5% and it earned 4% every year, you run those illustrations and you're going to see a massive difference in what you're expecting from that loaned out income down the road. And it's crazy how much 1% really adds up, but it compounds over time. And again, when you're not having that compounding for you in the form of interest, you're getting eaten up by fees. And that's where in some situations that can be really detrimental. Now remember, let me pause again and say I use IUL. So again, there's a way to do this properly for retirement. But again, if you're max funding something and you're very close to retirement, you're kind of hyper funding, as they call it, to try to pump out a lot of income, that's going to be a scenario you want to try to avoid. Which brings me to number 3, which is in-force illustrations. So what's really important and what you want to be doing often if you own an IUL is you want to be running in-force illustrations. Now, I have a whole criteria when someone calls me on an IUL that I run through with the company and them to get them all the in-force illustrations we need to see all the scenarios that could help them make the best decision possible. And it's a lot of in-force illustrations. I'm not going to sit here and try to give you the guide in this video. Maybe I could do another video where I break down how to call a company and get an in-force illustration, but it just would be too lengthy and people would get really bored. If you do want to run some in-force illustrations, you want to contact your agent and tell them, hey, I want to see different scenarios and what could happen. But again, what's hard for consumers is there's so many moving parts in it. You almost need to be an agent in order to figure out these illustrations. If you've ever called to order an IUL illustration before, you know there's a lot of things you have to know in order to get what you need to see accurate. Otherwise, their company can even be instructed sometimes to put other things in the illustration, like index bonuses that aren't disclosed, right? I've seen that before. I've seen all kinds of stuff. So it's hard to make sure that you're getting what you want to actually see to make a good decision. And that's why, if you'd like, I'm happy to call with you. We can call companies and figure out, or my team can, and help you figure out how to get the in-force illustrations to see what you want. Now, what's really important about in-force illustrations is a lot of times when you have poor performance early in an IUL, you can even see situations where the policy lapses. And that's what scares me most about IUL is I don't think people realize, like, there's a lot of people out there that are heading for cliffs and they have no idea. And that's why I'm trying to make this content to say, look, IUL is not bad, but it's got to be done with certain criteria and parameters to make it what I feel is safer for retirement. Because, IULs are sold on the premise that you're going to be putting your money into something safe, when in reality, when you have a tool where you could lose 100% of what you put in, to me, that's very risky. And I don't want that for anybody who's entering retirement. Nobody wants to lose all their money. People are often shocked when they go, what does lapse mean? And it means there's no more death benefit, and there's no more cash value. So running an in-force illustration to see where you're at is really important. You want to do this regularly. You want to run multiple situations. Sometimes companies can't solve for more than one variable, so you're going to have to run like multiple illustrations to see what you want to see. And so that's why I really just encourage you to talk to an agent and get that figured out. Now, if you don't feel comfortable talking to your original agent because you're very upset with the IUL, obviously that's why you're probably watching this video, and feel free to reach out to me and my team and we'll be able to help you. We're not in the business of severing relationships, but if you've already made the decision that, hey, you know what, this is not the path I want to go down, I want to try to figure out what I can do, then of course we're happy to help in that capacity. So thanks so much for watching. If you have any more questions on IUL, remember to go back and check out that video I made with the frameworks of life insurance. I think it'll really create some clarity around where you can use IUL in your retirement.